Hi, this is Dan Collins, Editor-in-Chief of Futures Magazine for Traders Exclusive. And today I want to talk a little bit about crude oil because it's been the most interesting market over the last several weeks. Yesterday, crude oil dipped below $75, a level many analysts said it would not go below. This is coming after many analysts believing 80 would be the bottom limit for crude oil. It's not the case. And there are several reasons why. First, there are a lot of bearish fundamentals. You have weak economy in Europe, weakening demand. You have the U.S. production that's growing. You have a glut of oil in the market. And surprisingly, a couple months ago, we looked at this and said, even though there's a lot of hot spots in the Middle East that you would expect a spike, you didn't get it. But there was pressure on price with production. Also, you're looking at crude oil, you have to look at the U.S. dollar. When they started this move in June, the dollar index was trading briefly below 80. We had a tremendous rally in the dollar that corresponded with the sell-off in crude. Crude oil around the world is priced in dollars. So you have to look at it in terms of the value that producers are getting. It hasn't gone down as much as you would think from the move from 108 to $75. A lot of people put out, when the cost of production, and if it goes below production, then it can't go down anymore. I'm sure there is a cost of production on every commodity, and no one's going to tell you the truth. When crude oil first spiked up in 2008, natural gas went with it to $15. And when natural gas was trading at $13 to $15, if you ask the producers what their cost of production, I don't know what they would have told you something around 8 to 10. They wouldn't have, but it went back down to under $3 briefly and stayed in the $3 range for several years. So that's really, like I said, there probably is a cost of production, but no one's going to tell you the truth on it. And it's a floating measure because when looking at all commodities, you also have to look at the dollar. The move in the dollar means that the price of the actual real value that producers are getting for their crude oil is higher. You also have the issue with OPEC. They decided not to cut production because the new production from the U.S. has the potential for taking market share away. So they're not as free to play with how much they produce. What it looks like right now is that they want to produce more and challenge that cost of production. But of course, when looking at all commodity markets, you have to look at it in terms of what the dollar is doing, because the $80 crude, when the dollar index is trading at 81, is a lot different than $80 crude when the U.S. dollar is trading at 88. So pay attention to that. We'll have more technical news for you on futuresmag.com. This has been Dan Collins. Have a great day.